Good morning, everyone. I'm Martha Stokes. I'm a chartered market technician, and I love to teach people and help them gain a lot of confidence so they can make more money in the stock market. Everybody asks, well, how do I gain confidence? Consistency in your trading and understanding who you're trading with, who you're not trading with, or against. You don't want to be trading against the buy side or who use the dark pool ATS venues. You don't want to trade against the HFTs. You don't want to trade against the professional traders. You definitely want to trade against your retail traders, your guru-led retail traders or investors, your investors who don't know anything, your odd lotters, that type of thing. So you want to remember that there are 4 positions in any stock. And at any one time, every one of those orders could be making money based on when they entered, their intent of the trade or investment, and so on and so forth. So don't look at it as if someone is making money and everybody else is losing money, because that isn't the case most of the time. If it were, nobody would want to learn how to trade stocks or invest in the market because they would be losing, everybody would be losing money. Most of the time when the market is trending upward, most people are making money if they know what they're doing. My job is to teach you what you need to know so that you can be successful. One of the things that you have to learn is there is an enormous amount of information in these stock charts, and you're not using it because you don't know it's there. It seems hidden, or it's not something that you really understand and can deal with. Back in April, we had kind of a flash crash because of tariff calls and things like that, and everyone panicked, and the retail side and smaller funds were selling down. There was a lot of support the market going on from the sell side institutions, and the buy side institutions came in and pushed this up because this was so far below Amazon's fundamentals, it was ridiculous. But then smaller funds came in and started selling more, so they pushed it back up. The only time that dark pools make huge long candles is when they are supporting the market. In other words, they have this vast amount of cash, far more than the banks have. And if they feel that the market is going to cause a panic, and 401k holders, owners, and IRA owners, and so on and so forth, are going to panic and start trying to get out of their stocks and into safe havens like cryptocurrencies or gold, then they try to push the market back up to stabilize and keep everyone from panicking. The buy side institution knows that if they can keep the market from collapsing, the indexes from collapsing to 20% or greater, which is the call of a bear, that the 401k and the IRAs and all the other investors who are long-term and who don't short-term trade like you guys do will hold and wait, because they have over the years learned that the market always comes back. The market always comes back. If you look at a Dow 30 chart, all the way back to when the first charts were made, way back in 1915, you will see that the trend is always upward. Yes, there are corrections. Yes, there are bear markets, but always it recovers and goes beyond the previous highs. And that's what we always have to remember. What we have right here is a fundamental support level. Now, Amazon is in the trenches of the tariffs and trade wars. It is an e-commerce that sells all kinds of products. It is the number one, the largest e-commerce in the world. It sells everywhere and everything. It also has all these small businesses that put their products out there and pay Amazon to have a spot and show their wares and so on and so forth. It also has AWS, which is their cloud technology and all of that. It's also partnered with NASDAQ to go into Europe and grow the U.S. stock market and financial markets in that area with AWS and other technologies. So it's a big, important company. Its fundamentals currently are right here. How do we know this? Because this was a previous fundamental level. When it exceeded it, it started to go in. Then we had this panic in the early parts of this year. Oh no, the world is coming to an end. No, it's not. It's just some things that have changed and we need to adjust and adapt. So it moved right back up to this fundamental level. And it's been here. It's doing a great job. They now have a lot of robots and robotics. They have probably the largest group in the world. I would have to check to verify that, but it's probably true that they have. They have over 1 million uh, robots and robotics in their American uh, facilities. So they have a vast quantity of robots. And we have this this talk going on everywhere about Chairman Powell, whether he'll lower interest rates or not, and he probably will because he's got between a rock and a hard place, and everybody thinks that that's going to solve the problem, but it's not. Because all corporations are moving toward robots. The reason why the report on jobs was so much lower was not because of high interest rates. Those interest rates are not what you pay. Those are the overnight lending rates to the banks by the FRB, the Federal Reserve Board Bank. Lends money to banks to make sure that they're always liquid at open. So if they're short of cash, they borrow some money from the Federal Reserve Bank, and then they have to pay it back with interest. That interest rate that you see that the FRB talks about, Powell talks about, is for the banks. The banks can still charge you a whole lot of really expensive credit on your credit cards or your car loan or your mortgage and so on. It doesn't necessarily mean that those are going to go down, and it definitely isn't going to help the job market. Now, this is a tough thing to swallow because I'm telling you a lot of stuff you've never heard about before, probably, and it's hard to believe because you want to believe the retail news. Retail news is very dangerous. Amazon, with its robots, has lowered its cost of payroll. So it has revenues that are starting to rise. We can see that over time, since the start of this year, end of year, that we have this accumulation going on that is steady and a little bit dip here and then right back up. So it didn't even go that far down here. This accumulation pattern shows us that the dark pools are agreeing. They often talk to each other, but not very often. They're often private companies like Vanguard and Fidelity are private companies. So you can't really see what's going on in theirs, but you can with BlackRock or State Street. So what we have is a fundamental level. And this is pretty much staying within that fundamental level because it is waiting for the third quarter earnings release and the projections or forecast or guidance, as it is called, from the CEOs. It's called guidance because it is not a prediction. By the time we start and get halfway through the third quarter, there's already almost 2 months worth of data already there. So the CEOs are able to tell you with a high degree of probability what the forecast is for quarter four, because they already know, because we're partway into quarter four when we start the earnings season. Okay. So they can guide or give forecasts that are fairly accurate, and they need to do that. The last thing they want to do is lie because they can go to jail for that. And they have to make the most important investors they have, the dark pool buy side institutions who hold vast quantities. This stock in itself has about 65% of all of its shares held by the large institutions. So they have to make those large institutions feel content, safe, and happy. And by the way, they go visit the CEO and CFO of Amazon and check it out and do a walk around and see what's going on. So they know what's going on. They can open the books and take a look at what's going on in any quarter and check it out. And they do it just before earnings season and during earnings season. So they know what's going to happen for the next quarter. So they're way, way ahead of you. So this is a fundamental level, and it may stay here, but Amazon is really pushing hard to mitigate the impact of tariffs. Our corporations are amazing, and they are able to step up to the plate and say, we are going to fix this problem. We have a problem. How do we fix it? They don't go around, well, we need to ask the government not to do the tariffs or something like that. They can't be bothered. They don't have time. They're all corporations are buying robots. 78% of all the corporations in the US are investing in robots and robotics. And so your job report is not likely to improve very much, even with the interest rates. For the banks, not for you, are going to probably go down a little bit or perhaps significantly. Meanwhile, all of you want to trade that big news because the HFTs are going to gap it up. Well, if you want to participate in that, you have to get in early, not late. You can't wait until the gap happens and then chase it. You have to start looking at stocks and seeing nudges and things that would imply that the professional traders and the buy side institutions are preparing that this stock is going to react to positively to a reduction of the interest rates to the large banks. And so we see some nudges and some opportunities going on in some of the big stocks that are very, very popular, because that's where all the retail day traders and all the guru-led retail traders and all the retail investors are going to be headed. So learn about fundamentals within the stock chart because they're extremely helpful in guiding you on what stocks that you might consider getting in early. I do not recommend stocks. I am not a recommendation service. I'm an educator, and I'm very proud to be a part of TradingView and educate you on how to trade wisely. That's our topic for the day.